In this lecture, I'll discuss the way that money is created in a fractional reserve banking system. I'll also describe the Federal Reserve and provide an overview of the Fed's monetary policy tools. If you haven't done so already, listen to the podcasts posted on the course website pertaining to the history of the Federal Reserve. Topics include the birth of the Fed's independence, and the Fed's actions in recent years. Today, in many developing countries, economic growth is being generated by microloans. Microloans are loans for very small amounts of money, so small that most banks wouldn't even bother to make them. However, these loans of say $50 or so are helping many people start small businesses in countries like Bangladesh, Afghanistan, and Burkina Faso, and are helping to lift many people out of poverty around the world. This is just one example of how lending can positively impact the lives of real people in an economy. Let's consider the way that banks create money. When most people think of money creation, they think of printing cash or minting metal coins. However, more than half of all the money in the money supply is represented by little more than a digital number in an account at a bank. In fact, most transactions that we see today take place through a system of electronic debits and credits to our bank accounts. In a sense, banks create money almost out of thin air. Because it can be difficult to wrap our heads around this concept, let's analyze this process of money creation in close detail. Suppose you own a restaurant, and in a month you earn $1,000 in cash and $1,000 in checks. You deposit the $1,000 from checks into a business checking account, and you store the $1,000 cash in a safe in your office. To you, there isn't much of a difference between depositing that money in a bank or in depositing that money in your personal safe. But to the economy, there is a big difference. The money in the safe is available to you and only you. The money in the bank is available not just to you, but to others as well. Banks hold deposits from thousands, if not hundreds of thousands or perhaps millions of customers. On a typical day, a relatively small percentage of those deposits will be withdrawn from depositors. Since customers don't demand all of their money at once, what does the bank do with the relatively stable amount of cash that it has sitting in the vault, so to speak? The bank will invest that money by lending it out to other customers in the form of loans, or in some cases, banks and credit unions will invest your money in financial markets. Banks charge interest on loans and use some of that revenue to make interest payments to customers with savings deposits or other deposits like CDs. Interestingly enough, when customers deposit the money that a bank has lent them, a percentage of that deposit can be lent a second time. Once deposited, perhaps at a different bank, a percentage of that deposit can be lent a third time, and so the money creation process is well underway. Let's consider an example using a T account, a simplified balance sheet comparing a bank's assets and liabilities. In finance or accounting, a T account uses double entry booking, often with debits on the left-hand side and credits on the right-hand side. For our example, I'll make it simple by putting assets on the left and liabilities on the right. The bank's assets include anything that the bank owns, or things to which the bank has a claim, and include things like the bank's building, its holdings of government securities, money in reserves, and money that the bank has lent out in the form of loans. Liabilities include money that the bank owes, and includes total deposits, which the bank owes to depositors, and the bank's equity, which will be paid out or split among the bank's shareholders. Equity is equal to net worth, which is equal to assets minus liabilities. When you deposit money into a bank, the amount of that deposit is a liability for the bank, since the bank will have to pay you that money back at some point. However, the deposit is also an asset to the bank, since it now holds the money in cash. In double entry bookkeeping, assets must equal liabilities. Let's suppose that the bank, Bank A, receives an initial deposit of $1,000. So assets increase by $1,000 and liabilities increase by $1,000. Let's assume that the bank must satisfy a reserve requirement. That is, a required ratio of funds that the bank must hold in reserves against deposits. Furthermore, let's assume that the reserve requirement is 10%. This means that the bank could lend up to $900 of this $1,000 deposit, while still keeping 10% of its cash in reserves. If the bank were to lend out only $500 of this initial $1,000 deposit, then the bank's current reserve ratio would be 50%, and Bank A would be considered highly liquid. Because the bank's current reserve ratio in this case is higher than the reserve requirement, the bank has excess reserves and could afford to lend out more money until reaching the point where the bank's current reserve ratio equals the reserve requirement. Great. So let's imagine that another customer comes around and applies for a loan. And suppose that the bank approves a loan for this customer in the amount of the full $900. But this time, we'll assume that this customer deposits the entire $900 loan into a checking account with another bank, called Bank B. Let's rewrite Bank A's transactions. Bank A has $1,000 in liabilities in the form of deposits, $100 in assets in the form of reserves, and $900 in assets in the form of loans. Bank B's assets increase by $900, since the bank now has $900 in cash on hand. And the bank's liabilities increase by $900 as well, since the bank will have to pay that $900 back to the new customer at some point. So far, $900 of money has been created from the initial deposit of $1,000. In other words, checkable deposits now total $1,900. Remember that M1 is a measure of the money supply that includes checkable deposits, so M1 has increased by $900. This process of money creation is the process of a fractional reserve banking system. Bank B has $900 in liabilities in the form of deposits, and decides to keep $90 in reserves, while creating loans of $810. In this example, all of the banks will be fully loaned up, meaning that they loan out all that they can, keeping in reserve only the amount required by law. And the process continues. This customer deposits the $810 loan into another bank, Bank C, and Bank C keeps 10%, or $81 in reserves, and loans out 90% of that, or $729. If this process continues, by how much will the money supply increase as a result of the initial deposit of $1,000? First, notice in this example that every time that a bank creates money, it does so by lending out 9/10 of the amount by which deposits increased. So we could write the equation of this change in the money supply as the initial amount of $1,000 times 9/10, which is equal to 900, plus 900 times 9/10, which is equal to 810, plus 810 times 9/10, which is equal to $729, and so on. We can write the sum of all of these amounts as the summation from I equals 0 to infinity of 1,000 times 9/10 to the power of I. Rewritten, we can pull the 1,000 out in front of the summation sign since it's a constant. Recall the properties of a geometric series. That is the summation from I equals 0 to infinity of r to the ith power equals 1 over 1 minus r when the absolute value of r is less than 1. Since the absolute value of r is equal to 9/10 or 0.9, and that is less than 1, the series converges, and we can calculate the total change in the money supply using this equation. From this, we can derive a simple potential money multiplier formula, which is as follows. 1 over the reserve requirement equals the money multiplier, where the money multiplier is the potential or maximum amount the money supply can increase or decrease when an initial amount in new deposits enters or exits the system. The potential money multiplier is rarely equal to the actual money multiplier due to money leakages. Think back to the earlier example. If any one of the individuals in the example had not deposited the full amount of their loan into a checking account, and had instead perhaps put some cash under their mattress, or if one of the banks had kept excess reserves, that is, reserves above the amount required by the reserve requirement, then the actual money multiplier would be less than the potential money multiplier. When banks keep excess reserves, this is an example of a bank leakage. While banks have a strong profit incentive to issue loans, banks attempt to reduce the risk of becoming insolvent by holding excess reserves during tough economic times. This is to ensure that they have the ability to absorb a higher rate of default. Banks may also choose to be picky when it comes to approving loans, avoiding potential borrowers with poor credit scores, no credit history, and high debt-to-income ratios. And this could also result in excess reserves. Insolvency is a situation when a bank's liabilities exceed its assets. If a bank has a high enough rate of default, this will be reflected on the bank's T account, where the bank's negative equity is listed under liabilities, and the amount of the default is negative, and listed under assets. The difference between assets and liabilities is a bank's equity, or value shared by the bank's shareholders. Leakages can also be caused by individuals and businesses when they choose to hold cash, which will reduce the effect of the money multiplier. Let's also consider the effect of foreign currency holdings. There are many countries around the world, like El Salvador and Ecuador, who have abandoned their own currencies and have chosen to use the US dollar as their only legal form of currency due to the relative stability of the dollar. As a result, nearly 2/3 of US dollars are held outside of the US. This reduces the actual money multiplier relative to its potential, but overall, this is not necessarily a bad thing, because the popularity of the US dollar around the world allows the US to print more money without worrying about a significant decrease in its value relative to other currencies. The actual money multiplier is probably closer to the following formula: 1 divided by the reserve requirement plus excess reserves plus cash holdings, where required reserves, excess reserves, and cash holdings are all together expressed as a percentage. The leakage-adjusted money multiplier tends to decrease during recessions. During the 2007 to 2009 recession, the actual money multiplier fell precipitously from 1.7 to less than 1. When the money multiplier is smaller, monetary policy becomes more challenging. During this period, the Fed attempted to encourage spending by injecting extremely large amounts of new money into the system. This is the perfect time to segue into a conversation about the Federal Reserve, its history, organizational structure, powers, and monetary policy tools. Early in U.S. history, banks were private and chartered by the states. In the 1800s and early 1900s, bank panics were common. It wasn't until the Federal Reserve Act of 1913 that the U.S. federal government created the Federal Reserve, which officially formed a year later in 1914. Prior to these events, there was no strong, independent, national, central bank to speak of in the U.S., though several were attempted. In fact, it was in the absence of a central bank that J.P. Morgan and a group of the wealthiest bankers on Wall Street personally bailed out the U.S. financial system using private money during the Panic of 1907. Meanwhile, on the other side of the Atlantic, central banks had existed for quite some time in Europe, though not always with the powers that they now have today. The Sveriges Riksbank in Sweden, the world's first central bank, was established in 1668 and is still in operation today. The Bank of England was devised by Charles Montague and established in 1694. The Bank of England became a model for most central banks that followed. In the U.S., there are 3 landmark laws that have done more than any other piece of legislation to make the Federal Reserve what it is today. They are the Federal Reserve Act of 1913, the Employment Act of 1946, and the Full Employment and Balanced Growth Act of 1978. These acts granted the Federal Reserve its power and legally mandated it with the following objectives: to promote stable economic growth, full employment, stable prices, and moderate long-term interest rates. Today, the Federal Reserve is arguably the most powerful institution in the world. It is an independent central bank in that its actions are not subject to executive branch control. In fact, there have been many instances when the Federal Reserve Board of Governors directly ignored and even acted against the wishes of a sitting U.S. president. Despite this, the Federal Reserve is still accountable to the public and is subject to congressional oversight. The President has the authority to nominate the Federal Reserve Chair from among the members of the Board of Governors, and the Chair serves a term of 4 years after being confirmed by the United States Senate. All 7 members of the Board of Governors serve staggered 14-year appointments. The current Fed Chair, Jerome Powell, was nominated by President Trump and confirmed by the U.S. Senate in January of 2018. Powell was preceded by Janet Yellen, Ben Bernanke, Alan Greenspan, and 12 other Fed chairs. The purpose behind the Federal Reserve's independence and the long-term appointments of its members is to reduce the likelihood that its decisions are influenced by short-term political pressures. The Board of Governors, along with nearly 2,000 staff members, carry out the responsibilities of monetary policy, as well as the regulation of banking and consumer credit. This map contains the 12 regional Federal Reserve banks and their corresponding districts. The 12 regional Federal Reserve banks and their branches perform a variety of functions, including providing a nationwide payment system, distributing coins and currency, regulating and supervising member banks, and serving as the banker for the U.S. Treasury. Each regional bank also provides the Federal Reserve System and the Board of Governors with information on economic conditions in its home region. 8 times a year, this information is compiled into a report called the Beige Book. The Federal Open Market Committee, or FOMC, is comprised of the 7 members from the Board of Governors, the President of the Federal Reserve Bank of New York, and 4 of the remaining 11 Reserve Bank presidents, who serve 1-year terms on a rotating basis. The FOMC oversees open market operations, which is the main tool of monetary policy. The Federal Reserve also serves as lender of last resort. During times of economic hardship and financial turmoil, there is a tendency for depositors to panic and demand all of their money from banks at the same time. This is called a bank run. During such times, many banks would be forced to dump their securities and loans onto the market at a deep discount, and many banks would likely be forced into insolvency. So also, many customers would lose their deposits like they did during the Great Depression. In the U.S., the Federal Deposit Insurance Corporation, or FDIC, now protects bank deposits up to $250,000 from bank failure. In addition, the Fed steps in during financial crises to provide loans, extend credit, and even, as they did in 2008, buy up large sums of risky assets. The Fed lends at times when no one else will. During economic recessions, everyone wants to hold their money, and no one wants to lend money. Were no one willing to lend except at extremely high interest rates, borrowing and spending would decrease, unemployment would rise, and it could take a very long time for the economy to recover. The Fed attempts to encourage spending and borrowing and restore the confidence of investors, firms, and households in markets. Let's examine the Fed's policy tools and discuss the difficulties of implementation. The Fed uses 3 primary tools for conducting monetary policy: reserve requirements, the discount rate, and open market operations. Let's talk about reserve requirements. The efficacy of monetary policy depends on the money multiplier, which depends on the reserve requirement. Roughly 13,000 depository institutions are bound by the Fed's reserve requirements. Member banks hold 2 types of reserves: required reserves and excess reserves. Reserves are kept either as vault cash or in accounts with a regional Federal Reserve Bank. These are called federal funds or just Fed funds. Banks are assessed a penalty if their accounts with the Fed are overdrawn at the end of the day. Given the unpredictability of the volume of transactions that may clear a bank's account on a given day, most banks choose to maintain excess reserves. When banks find themselves low in liquidity, they may not be able to meet the required reserves established by the Fed. If, at the end of the day, a bank does not have enough money on hand to meet their reserve requirement or to satisfy depositors' cash demands, a bank will have to borrow money in the form of an overnight loan from other, more liquid member banks, or directly from the Fed. When banks borrow and lend federal funds amongst themselves or trade reserves, they do so in the federal funds market. Federal funds are generally considered 24-hour money. This market, subject to the laws of supply and demand, dictates the price of bank-to-bank loans, i.e. the interest rate that banks charge each other for overnight loans used as reserves. This interest rate is called the federal funds rate. In 2006, daily loans between banks in the federal funds market averaged $338 billion a day. However, the size of the federal funds market has decreased significantly since the beginning of the financial crisis. In 2007, banks lent over $200 billion, and by 2012, banks lent only $60 billion. This is due to the fact that the Federal Reserve increased the size of its balance sheet to $4 trillion through quantitative easing, leaving a large amount of reserves on their balance sheets. And the fact that the Fed now pays banks interest on excess reserves, they have reduced banks' incentives to lend excess Fed funds. To recap, the reserve requirement has a significant impact on the behavior of banks. In spite of this, or rather because of this, the Federal Reserve rarely uses the reserve requirement as a monetary policy tool, and prefers instead to use open market operations. However, about 2.5 weeks ago, the The Fed announced on March 15, 2020, that the Board of Governors would reduce the reserve requirement ratio to 0%, effective March 26, 2020, as a response to the COVID-19 pandemic. Why would the Fed do this? Because, at this time, the Fed desperately wants banks to lend money to households and firms. In the last 3 weeks, a record-breaking 10 million workers filed new unemployment claims. U.S. stocks suffered the fastest fall from all-time highs to bear market on record, and business output is predicted to fall dramatically, with Goldman Sachs saying it expects a 24% drop in the second quarter of this year. The Fed wants to increase the amount of money circulating in the U.S. economy in hopes of stimulating aggregate demand to combat the looming recession. The discount rate is the interest rate that the Fed charges member banks to borrow reserves from a regional Federal Reserve Bank for short-term loans, typically overnight loans, made available through the discount window. The discount window is an instrument of monetary policy that allows eligible institutions to borrow money from the central bank, usually on a short-term basis, to meet temporary shortages of liquidity caused by internal or external disruptions. When institutions borrow from the Fed at the discount rate, they must provide acceptable collateral to secure the loan. By providing ready access to funding, the discount window helps depository institutions manage their liquidity risks efficiently and avoid actions that have negative consequences for their customers, such as withdrawing credit during times of market stress. The discount rate is typically set at roughly 0.5 percentage points higher than the FOMC's target federal funds rate. The Fed does not directly raise or lower the federal funds rate. Instead, the FOMC sets a target federal funds rate and then implements open market operations to achieve that rate. So banks have two choices. They can borrow from other banks at the federal funds rate, or they can borrow from a regional Federal Reserve Bank at the discount rate. In normal economic times, banks tend to avoid using the discount rate because it is a negative signal that the bank might be at risk of failure. To avoid raising suspicion from customers and from the Fed, banks would rather borrow money through the federal funds market rather than through the discount window. So, to summarize, banks generally prefer to borrow from other banks for 3 reasons. 1, the federal funds rate is cheaper than the discount rate. 2, overnight loans from other banks do not require collateral. And 3, since borrowing from other banks is common, it doesn't raise the suspicions of customers and the Fed. On March 15th, the board announced changes to the discount window. These changes included the following: narrowing the spread of the primary credit rate relative to the general level of overnight interest rates to help encourage more active use of the window by depository institutions to meet unexpected funding needs, and announcing that depository institutions may borrow from the discount window for periods as long as 90 days, prepayable and renewable by the borrower on a daily basis. In the last lecture, I covered the basics of U.S. Treasury securities. The FOMC alters the money supply and banking system reserves by buying and selling government securities, such as U.S. Treasury bills and bonds. These actions are called open market operations. Open market operations are the most powerful and most frequently used tool of monetary policy by the Fed. The Federal Reserve Act specifies that the Federal Reserve may buy and sell Treasury securities only in the open market. The Fed meets this statutory requirement by conducting its purchases and sales of securities chiefly through transactions with a group of major financial firms, so-called primary dealers, that have an established trading relationship with the Federal Reserve Bank of New York. Conducting transactions in the open market, rather than directly with the Treasury, supports the independence of the central bank in the conduct of monetary policy. Most of the Treasury securities that the FOMC has purchased have been old securities that were issued by the Treasury some time ago. The prices for new Treasury securities are set by private market demand and supply conditions through Treasury auctions. Suppose that the Federal Open Market Committee buys $300 billion in longer-term Treasury securities, as it did in the first round of large-scale asset purchases from 2008 to 2010. Instantly, $300 billion of new reserves are put into the banking system, and these new reserves have the potential to expand the money supply by the spending multiplier, as banks make loans via the fractional reserve banking system. Here's a question for you. How does the Fed influence the federal funds rate if it cannot do so directly? Recall that when the Fed buys bonds, the increase in demand raises the price of bonds, thus lowering nominal interest rates in the market. When the Fed sells bonds, the increase in supply lowers the price of bonds, thus raising nominal interest rates in the market. And historically, the Fed has been very precise at keeping the federal funds rate near the target rate. You can see in this graph, from 1985 to 2010, that the Federal Reserve has been successful in getting the effective federal funds rate close to the federal funds target rate. This graph basically shows the same thing, but from 2009 to 2020, using the Fed's new metrics of upper and lower limits on the target range. As of March 15, 2020, the FOMC set the target range for the federal funds rate to between 0% to 0.25%. This is legally the lowest limit for the federal funds rate. And this too was in response to the economic consequences brought about by COVID-19. Just a few weeks ago, the Fed announced that it planned to buy at least $500 billion in Treasury securities and $200 billion in government-guaranteed mortgage-backed securities over the coming months. But on March 23rd, it made the purchases open-ended. In the first week of the new program alone, it said it intended to purchase $375 billion in Treasury securities and $250 billion in mortgage-backed securities. To help finance multi-family housing, it also expanded purchases to include commercial mortgage-backed securities. I included a rather long but detailed description of mortgage-backed securities in the transcript posted on the course website. These open market operations on the part of the FOMC is an attempt to stimulate economic growth in response to the coronavirus. Just in the last 3 weeks, you can see the Federal Reserve using all 3 monetary policy tools to enact economic stimulus during this pandemic. You may ask, how effective will these monetary policies be? Well, time will tell. But perhaps you remember from a few lessons back that we covered the difficulties of implementing fiscal policy. In particular, those difficulties are best explained by timing lags. So too, there are monetary policy lags that make it difficult for monetary policy to be effective. There are 4 types of lags: information, recognition, decision, and implementation lags. The rationale behind information, recognition, and implementation lags are very similar for fiscal and monetary policy. However, it should be noted that decision lags tend to be shorter for monetary policy because the Fed doesn't need to go through the political process. Once the Fed makes a planned decision, the FOMC can almost immediately put that plan into action. However, it could still take a long time for banks to channel a new money injection, and for the process of depositing and loans to effectively increase the money supply. Economists estimate that the average lag for monetary policy is between 12 and 18 months. This wraps up the first lecture on monetary policy. I'll provide more information about expansionary and contractionary monetary policy in the next chapter.